The Indian securities market, under SEBI's regulatory purview, began its journey in 1988. However, the roots of Indian securities market can be traced back to the beginning of 18th century, making it the oldest in Asia. Dharohar, an initiative by SEBI, is an endeavor to capture the evolution of our nation's securities market. Dharohar has three distinct offerings that allows users to step into the evolution of India's securities market. Interactive timeline, immersive galleries, and informative website. With interactive timeline, uncover the milestones with seamless navigation features, from pivotal events to iconic personalities, and from various markets to their regulations. In its second key offering, Dharohar brings you 8 distinct virtual galleries like share certificates, mutual funds, commodity markets, debt, equity markets, and personalities. The experience doesn't end here. Lastly, the website is a unifying platform for all visual and textual information available across Dharohar. Here, one can dive into a wealth of knowledge like never before. Watch interviews of eminent personalities that have shaped the Indian securities market. Understand complex market concepts through engaging informative videos. Explore key moments of India's financial history with newspaper clippings and share certificates. This is Dharohar, a bridge between legacy and progress. Preserving history, safeguarding the present, educating generations, inspiring the future, and continuing to grow and evolve with time.
So that was a video on SEBI's virtual museum, Dharohar, Milestones in the Indian Securities Market. It is a comprehensive digital repository documenting the evolution of Indian securities market through historical archives, newspaper clippings, interviews with eminent personalities. Participants are encouraged to visit the museum for further learning at mism.org. Link will be pasted in the chat box for your reference. So, hello and good evening, everyone. I am Mansi Ghanekar from the Investor Education Department of NISM. NISM is the capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. To begin, I would like to wish you all a happy very Guru Purnima. Guru Purnima is a day to express gratitude to our teachers and mentors who guide us toward wisdom and informed decision making. In the world of investing, the right knowledge and disciplined approach can become a greatest guide. With that thought, let us explore today's topic, Passive Investing, Building Wealth Through Simplicity and Discipline by Mr. Anil Gilani. Anil Gilani has been working with DSP Group since 2003. The TSP Group has a legacy of more than 160 years, making it one of the oldest and most respected financial services firms in India. He is currently head of passive investments and products, managing a range of ETFs and index funds across equities, fixed income, and commodities. Previously, he served as the CEO and Chief Investment Officer at DSP BlackRock Pension Fund Managers. Earlier in his career at DSP, he led the risk and quantitative analysis team, providing quantitative research inputs and buy-side credit research on companies across various sectors. So I would request Anil sir to begin with the session.
Sure, thank you very much. And good afternoon, good evening, good morning, friends from whichever part of the world you've joined online for this session. I would like to kickstart with carrying on further from the introduction about the relevance and importance of today as not just anything auspicious or religious or spiritual, but in general, Guru Purnima is something where we sit back, pause, and reflect upon all that we have learned and just in some small way or the other try to enhance our knowledge. So, with that context of knowledge enhancement, I just wanted to kickstart our session for today. What I'll do is that we'll take approximately 30 to 40 minutes to discuss the core subject and the theme. And after that, what we'll do is that we'll keep it very open and free flowing and take questions, comments, suggestions from all the participants. Before we kickstart, I just wanted to share one thing from my side. It's a very engaging topic, passive investing. We cover ETFs, index funds specifically, and how they are growing, what are the key concepts, and how you can put it to use. Hence, I'm very keen. I want to have as much as possible engagement, interaction, so that you feel that yes, it's some kind of a communication and learning rather than just sitting and watching some session going on at the back end. So at all points of time below the screen where you are seeing me right now and the slides in front of you, there is a section for Q&A and comments. I think it's called Q&A session where you can keep typing any questions or comments that come into your mind, and we will take it up as we move ahead. And my request is, at some point of time, friends, in this past couple of years, we have all been part of so many online sessions, and sometimes it just gets a little boring. So many are what's going on, boss, or like I'm just switching off basically, you know. So to keep it live and active, even if there is no question, I will request all of you to make use of the typing window and write something which will give the engagement and update to me and to others that there is something going on and there is an activity happening. Okay. So can we kickstart with a very quick suggestion or comment on the box? Wherever we feel that yes, things are going fine, it's okay and all right, just type the letter A, signaling all right or anything like that, just write A. And if you feel you know, something is going wrong, I can't hear you, somebody wrote a comment right now, volume is low, anything like that, then just type the letter N. And for no. All right. So quickly, let's see something A. Wonderful. Dhruve, Jyoti, Pankaj, Rishi, Ganeshi, thank you very much. Okay, let's kickstart quickly. Thank you guys. Keep the comments and responses coming so we know everybody's in sync and in action. Now, very quickly to start off, of course, this is very important. We are part of NISM under our regulatory purview of SEBI. All of us are familiar and aware with various compliance restrictions. This is a very important restriction from my side. I also work in a very regulated environment. So just wanted to highlight that today's our entire discussion or anywhere where we engage, it's in my individual personal capacity, not as a representative of NISM or my employer organization. Quickly jumping into what the concept of passive investing is. And for that, first and foremost, we need to look at what is active investing. So just to make it lighter and to kickstart, you know, on the afternoon, just during tea time, I've also tried to incorporate some graphics, some photographs, etc. So this is a very popular film, animated movie with multiple series. Anybody guesses, just type A or N and it will be very interesting to know. Here, if you remember, a lot of learnings from this movie, friends, not just a comedy movie, but a lot of powerful corporate learnings as well. In this movie, how the thing had worked is that there is a particular concept which the panda is being taught, that there is some secret ingredient which is making the soup of his father, the bird, very famous. So if you think of active investing, the core concept or the key thing for active investing is that there is a subjective element. There is a top-down view being taken on certain themes or certain sectors, and then a view is formed on certain companies bottom-up, stock by stock research. So in entire process, there is a key ingredient or secret sauce, which is a judgment of the fund manager and research analyst. Something like that, you know, like a secret sauce. Okay, I'll sprinkle this and it will emerge as a very tasty and yummy dish. Now, if we contrast this with what we typically try to understand by passive funds, where there is structurally no research or fundamental judgment being applied by the analyst on a day-to-day basis. But instead of that, there are certain rules. Instead of that, there are certain parameters based on which this particular investment style works. So again, very similar to what we saw in this particular movie itself, whereby after some time, the panda realizes that it's mainly his hard work and diligence and certain process and methodology which the training teaches him, which makes him the dragon warrior. So for the passive investing, structurally, there is no human intervention. In that sense, you can think of it as a rules-based approach without this kind of a secret sauce being incorporated. Mind you, friends, at the time of designing the investment strategy or designing the index or creating the universe in which the investment will happen, after that selecting for your personal investing or for your clients investing that which particular theme is working in the market right now, hence where I should invest, all that does need subjective thinking and research and analytics. The key difference is that once that subjective element or that research or those rules are set, then on a day-to-day basis, there is no human bias creeping in the management of the portfolio. That's the key difference when we think of passive investments like ETFs and index funds compared with actively managed portfolios, which we see in the markets. Everybody with me, friends? Okay, wonderful. I'm seeing few comments and few A's. Fortunately, not many N's right now. 1 or 2 N's have come, but yeah, okay. Chat is disabled. Yes, friends, chat is disabled because the Q&A is there, which is enabled. So you can please feel free to capture data on the Q&A section. Now, moving forward, how we see what happens in smart beta. So when we talk about passive investing, what we are trying to do is capturing the beta of the market typically by investing into the particular index or ETF. In some different aspect, when we think of smart beta, very often there is a narrative in the market that, okay, I want to buy beta or I want to buy smart beta, something differentiated. So wherever we are trying to enhance the return little bit or reduce the risk little bit, or of course, if the combination of both happen, then wonderful, that's what we want. When we are making any investment, what is our core objective? That, okay, I should get some good returns and have my risk as low as possible. That's the best thing, So by tweaking some part of the formula or by tweaking some part of the pure beta or market cap based weightage of my stocks securities in the portfolio or index, if I'm able to create some strategy or some portfolio which has the potential, again, it's not a magic wand, it's not something which will always happen, but if it has the potential to slightly increase the possibility of higher return and slightly reduce the risk with little bit better diversification, then that's what we are trying to achieve and what we mean by smart beta. Now, something aligned with that and how exactly we can create smart beta strategies is by understanding what are the constituents or what makes up the risk and return drivers of any security or asset class. Friends, to put that in context, let's say, for example, we are preparing for, let's say, some big match or a marathon coming up in the city. How the nutritionist will tell us that, okay, make sure you have certain amount of carbohydrates, certain amounts of protein, and certain elements of fat in your daily diet, which will design the way in which you are supposed to maintain your food intake and diet intake for the next couple of months till the marathon comes up. Very similar to that, if you dissect the risk and return drivers of any security or index into different components, it can be value, growth, quality, size, etc., and then try to incorporate those into your investment strategies. Like in the case of the food, the nutritionist has given you guidance. Similarly, over here, your trusted financial advisor, or if you are an advisor or you are a financial planner or you are a fund manager or research analyst, then you have to think through these, superimpose that on the top of the current view in the way in which the economy or the markets are working, and then try to create that particular subtle aspect of the smart beta using one or two or more of these factors where you want to go overweight or underweight, and then decide and design that particular investment strategy. With me, everybody? Fairly simple till now. Looking at active funds, whereby somebody, individual, a human judgment is being taken. She or he, the fund manager and analyst, is applying that and creating a portfolio. Over here, a lot of research and judgment is being put at the inception while deciding that particular theme or strategy. After that, no human bias. And at certain points of time, the constituents, the factors incorporated there are being utilized to form or create that particular strategy. Okay. Now, let's quickly see that what is the whole noise about. Everybody's saying that passive is growing. What is happening? Why it's growing? How we have seen other markets globally. Let's take a quick dive into that and look at some data, how it has grown. So, if we see the US market, we have seen that passive investments in the US market have been rising in this last decade or so. So, approximately 12-15 years back, in 2013 was the first year whereby passive funds in 1 year saw higher total returns as compared to active funds. So there's a lot of noise around it, but people said that still passive funds is a large component, of the total size. Around 75% of the total assets under management of passives were were actively managed, 73%. And only 27% was passive funds. As we move forward, friends, and we came 1 decade away in 2023, it was the first time when passive funds total share came to 50%. And now, couple of years in future, means currently it is well above 50%, whereby we have seen now active funds have dropped to 46%. And passive funds, means ETFs and index funds, passively managed products, including smart beta, what we spoke about, have overtaken even the total block of AUM, and it's approximately 54% of the total US mutual fund industry. Now, of course, we have a lot of reason that is different industry. It will take time, different aspect. India has different context, etc. No doubt. But this is just some number to keep in mind, that if we think that like many other markets or many other trends, India also will follow what we have seen in some of the other global markets, then yes, we need to be clear and aware that there could be a reason whereby the markets in India also, we will see a bit of a alignment more towards the passive investments. Where we stand today, let's take a look at that, friends. So today, as at end of June, in India, we are approximately 18% of the total size of our mutual fund industry. So in some way, you can think that connecting this with the previous slide, we are in 2010 times what US was, like maybe 2008, 9, 10, somewhere where US must be around 18 to 20% size, and then it grew gradually from there. Again, I'm not saying US took 10 years, we might take longer, or it could well be that we will never reach 54%. But most certainly, in my view, from the current levels of about 17-18%, I would feel in the next 5-10 years, we will definitely grow to about 30% of the total industry. So it's very important, friends, whichever part of the industry you are either working in or being part of NISM, you could be a young professional, you could be a student, you could be somebody who is enhancing your knowledge. It's important to recognize and be aware of what these passive funds are, how we've seen in them in some of the global markets, how they have grown, and potentially how there could be a future growth coming across in India as well, just so that you are aware in terms of whether aligning your professional career towards that or using this to help you in your own personal investments, planning for your long-term life goals. And with that, I'm just going to take a very quick pause in between. I hope we are doing fine. Everybody with me till now. We have finished approximately 15 minutes. So I'm just taking a quick 30-second break. Anybody A or N, everything going fine? While I'll move to my next slide. Okay, great. Now, coming to the original reminder that yes, what today we are here to discuss about passive funds, about simplicity of investing. And here is a very interesting data point and chart. Little bit busy because there are too many numbers. So I have highlighted 3 key numbers over here, friends. Look at the way in which index funds and ETFs have grown in the past about 5-7 years in India. If you see, there is a time over here whereby we can have index funds. In 2020, total size of index funds was only approximately 8,000 crores. Okay, and we had around 5 lakh folios. Now today, that number is risen to 3,07,000 crores, from 8,000 to 3,07,000 crores. And number of investors, friends, which was 5 lakhs, has grown to 1 crore 50. So we have seen a dramatic increase, around CAGR growth of 80% in AUM and around 70% in number of folios. Likewise, in ETFs, these are ETFs other than gold ETFs only, massive increase whereby we have seen the total number growing rapidly. We are close to around 9 lakh crores over here. 8,94,000 means around 9 lakh crores over here. And even number of investors, where we are only 18 lakh investors, it is grown now to 2 crores 79 lakh investors. So again, a massive jump in terms of the interest that is being seen in passive funds. Maybe, friends, some of it could be just because of the way in which we are seeing the investment world evolve. Maybe some of it could be because, after so much digitization, we have so much convenience and ease of opening demat accounts, etc. So we are able to open ETFs accounts very fast. Awareness of broking, etc. stocks have been increasing manifold. Whatever might be the reason, but the numbers are right up front in our mind to be aware that it is growing very rapidly. Awareness is increasing, and hence, like I said earlier, not that we have any exact number that when we will cross what we saw in the US above 50%. But yes, definitely we are in a fast track moving towards better adoption of ETFs and index funds in Indian capital market as well. Now, structurally, friends, the idea should be that we need to use the power of both together. In any ways or in anything that we talk about, always I believe the power of and is more than or. I'll take example. Might be today, some of us are joining online, some of you are in office, some of you are in college. Around 4 o'clock, 5 o'clock, everybody has a time for a break, right? I want a tea break, coffee break. So suppose if somebody asks you, okay, sir, today or madam, today you want a hot beverage, means you want a tea, coffee, or you want a diet coke, basically. Suppose you have to choose between, or you want a tea or a coffee or a diet coke. It's so difficult to choose, right? But suppose somebody has placed it in front of you. Okay, abhi 4 or 5 ke beech, between 4 p.m. and 5 p.m. You've got a wide range. You can have either tea or coffee, or you can have a diet coke, or if you feel something more, you want to have some like a Nimbu Sharbat, based on whichever city you have joined in from. And NISM as a broad context, global as well as local, in any part of the country you would have joined from. If you feel it's very hot in my city right now, I just want a cold beverage, just a lemon water. Okay, then the power of and versus or, it becomes very strong. Something similar we should use in investing also, friends, whereby instead of thinking that, oh, I will use actively manage one fund or passively manage, let's use both as a core and satellite approach. This becomes a very powerful way to use or incorporate passive funds into your portfolio or to your client's portfolio. If after that we say, Anil, let's go to next step. I have decided I want to use some passive funds. I want to buy some ETFs, some index funds, use it in my portfolio, and help me how to select which fund house to use. Of course, the idea is very, very simple, very, very easy. You need to go with where you feel highest level of comfort. take the example of our session today. Some of us have logged in from your mobile phones. Okay. How many in the chat window or question is put M for mobile and L for laptop? Just for knowledge, just for that sake, just to ensure you are typing something, just to mention you are awake and not falling asleep without your cup of coffee or tea or green tea or diet coke, whatever. L for laptop, M for mobile phone. Okay. Mixed responses, something like that. Okay. Somebody saying yes. Somebody will say even D. Arey sir, मैं तो desktop से login किया हूँ. All right. Wonderful. Just trying to gauge that what you can do whichever you feel most comfortable. Today, technology is there to support everything and anything. You can log in from the biggest, somebody say, I log in, sir, from the TV screen on my, in my sofa, because that also my home is Wi-Fi control. I just press a button and NISM webinars come up on my big screen. Okay, wonderful. Whichever way you feel maximum comfort, you need to do it. Just similar to that, even when selecting the fund house, whose ETF or index fund you want to invest into for yourself or for your clients, in either ways, friends, you need to, in my view, focus on multiple things. I have listed down 6 important points over here. Let's quickly go through them one by one. It will be very useful later on when you are looking at it. First and foremost, look at the investment concept, whether it's aligning with your point of view current in the current market or not. So, like we spoke, beta and smart beta, right? Suppose you are thinking that I want to just buy beta of the market. Let's say broad market index like a Nifty 50 or Sensex 30. I will just buy it and keep it. Or if you feel, no, I want something different. I feel right now there could be a very broad-based market rally. Instead of Nifty 50, let me use some other form of smart beta. Let's say for simplicity's sake, I use Nifty 50 equal weight index and buy an index fund of ETF. So I have my concept ready, which is aligned with my view of the market today. For long term, I want to invest in Nifty 50 equal weight index fund, for example. Now I will see which fund house has got this particular investment concept available. Then I'll see, whether it's aligning with my expected risk or returns. Yes, it is. Then let me see whether that fund house, friends, has got a dedicated investment desk. How serious is that fund house in managing ETFs and index funds? Very often, it could well be that it is a side business. Just by the way, let's have something available. Versus some fund house might be having a very dedicated investment desk and a serious focus on that. So that's also a very important, subtle, subjective element of qualitative aspect to evaluate. Friends, we are all aware that very important to check the ease and convenience of making that transaction. Like, okay, is there a branch close to my home? Can I access digital platform of that particular fund house? Is there customer service friendly, etc., whatever might be? And of course, most important fundamental and quantitative aspect, that what is the tracking difference, tracking error, tracking difference of the particular index. Most important is tracking difference. Tracking error is of course useful and relevant to see, but it's a very statistical number, formula wise. Tracking difference is very easy. What is the return of that underlying index or strategy, and what is the return of that particular fund? And the gap between the two is your tracking difference. Very simple, straightforward. And of course, the servicing, ongoing reporting, etc. So for example, friends, you all know today we are in the midst of July, end of July, right? For many of us, including me, or some of you who are students, etc., our income tax return filing deadline is 31st July. Right? We need certain reportings from our fund house. Everybody who has filed the returns, just type A. Okay, I filed, I'm assured and relaxed. And you are waiting and anxious yet to file your tax returns, just type N. Oh, I'm very much shut this session fast. I have to go and file my tax return midnight. Last 2 days left. Just on the lighter side, friends. But yeah, good to see some responses coming through. So whether the fund house is friendly in giving me such reports, will I get Excel templates of my reporting servicing? So sometimes, friends, all of these 6-7 things together is what is important for us to determine which fund house I should invest my money into. So we covered till now what are passive funds, key difference between active and passive, how they've grown in global markets, what are the trends we are seeing in India, how they will grow, how you can use it for your personal investments or for putting to use for client investments. such that it can help in a combined powerful effect. The power of and versus or. Use both. Don't use active or passive. Try and use little bit active, little bit passive to make it a powerful combination of core and satellite. And of course, by the way, we heard about many of the friends talking to each other. I don't know whether you can see somebody else's questions, but I can see everybody's responses of P and A and L and laptop or desktop and the smart TV. So greatly appreciate the participation. And again, I'll take quick 15-second pause while anybody has any inputs, suggestions, questions. Please note it down and we will be responding to as many questions as possible. We have carved out time for that. Before I jump into the next slide, quick 10-second, 15-second pause. Please think of your questions, post it over there. Okay, wonderful. Now moving on further to the most important part, which was in the heading or in the title of the discussion, friends. What was that? Building wealth through discipline and simplicity. Building wealth through discipline and simplicity. Very important concept, friends. So let's quickly jump into that. If you are thinking of it from your own self, if you are thinking of it from advising to your client, etc., how we should think of it. Again, I'll just take the example of one very popular movie. I don't know if some of you might have seen it, The Pursuit of Happiness. Very important movie, very useful. Sometimes such things teach you a lot of things. So what are we pursuing? What are our goals basically, right? For many of us, of course, for some of you watching online, you are young professional students. Your goal is to clear your NISM or some other examination. If you are an MBA college student or you are pursuing a CFA, FRM, etc., or you are a financial planner advisor, how to meet your clients' goals, or if you're doing your own personal investing, how to look at it. But structurally, friends, just think of it. What are your key goals? Maybe structurally, I want to buy a new car. Maybe I want to start my own business, plan for buying my second home. Some of you will say, boss, all that I don't know anything. I just want to get rich. Then I'll decide. I'll just do what I like. Some people are very measured, very methodical. I want to plan for my long-term retirement, retire well, FIRE, fire, everything nowadays ka thing, whatever might be. But structurally, friends, if you dissect everything, look at it personal self, our goals which will give us happiness are very simple, very tangible. Nobody's asking which fund is doing well or which particular manager is going to shoot the lights out and perform really well, or should I buy Bitcoin and Bitcoin will get a number or whatever. It's separate, secondary. So keep in mind this concept, friends, I'm introducing right now called life goals. Understand and identify the difference between life goals and financial goals. If you want, later on, we can take one separate session completely around this aspect of how to think of life goals as an important part of financial planning, wealth management, and how to work around it. So we must always remind ourselves, whether us as an investor or as a financial professional for our clients, that our life goals are often very easy, very simple. They are often aligned with the happiness of our family or our own starting new business, etc. But sometimes we often get preoccupied with wrong priorities, which is not sustainable for long term. Oh, I want to increase my fund return. I want to buy the next big multi-bagger and I make my hair white around it. So very important aspect, life goals. Not many books you will read about it, but if you are a finance professional working in the area of wealth management, financial planning, please take time to carve out and grasp this difference between life goals and financial goals. Both are very important, friends. Mind you, I'm not saying no. But first, define life goals, then align your financial goals with each life goal, and you will have a much more powerful solution in place. Once you have done that, this is a very important message. Many of you might have read this cartoon. It comes often. It used to be more frequent in some of the daily newspaper. Nowadays, many people don't read newspaper, so you can maybe follow this on some of the social media handle. Calvin and Hobbes, very popular. So this young boy is just sitting under the tree and relaxing, and the tiger, his friend, comes, "Ke boss, aap kya kar rahe ho? What are you doing, boss?" "There's nothing, I'm just being cool." So he said, "No, I think you are being bored. You are looking very bored." So he said, "No, sometimes the world bores you when you are cool." So aligning this financial goals with your life goals, then being cool, and then thinking of this in the context of what we learned about passive investing, whereby we want to have a concept of no human bias. Important to understand the difference between where we can fit it in terms of our core and satellite. Once that is done, our goals are mapped and planned. Then very important that we remain cool, not get carried away or instigated by somebody coming in saying, "Hey, yaar, you are just sitting. What are you doing, man? This is not fun." Doesn't matter. Very often, the best investment outcomes, of course, after the initial groundwork and the initial effort that you put in, after that, the best outcomes often come if you follow a boring investment cycle. Very often. And it's difficult. It's very difficult, but we need to gradually learn the difference between the two. What I mean by that is be active in your life, passive in your portfolio. Now, friends, here I'm not talking anything philosophical, कि भाई life में क्या करने का, ऐसा. Not that type of active in life. What I mean is that focus on many other aspects, like we spoke about. You have certain life goals, which are very easy, very comfortably measurable. Try to enhance those life goals, uplift your way of thinking and living. And for your investing portfolio, unless you are a person like me or any financial markets person, whereby investing or daily tracking is your job, of course, then you have to be active in that. Then that becomes your life. But otherwise, do that and be passive in your portfolio. It's very difficult, but gradually we need to align and learn with that. And let me show you a very easy tool or an example how we can learn about it. Many of us do it every day. How many of you friends drive a car either in Mumbai, Delhi, any of the metros or any other city where there is a long stretch of a highway and you use cruise control or auto control in that car? Just quick type in the window, chat question window. Cruise control or CC means cruise control or manual car. Just to see the pulse of how people are driving. And let's superimpose that on learning in our real life. Let's learn from how a pilot would be doing. When the aeroplane is going to take off, at that point of time, very hard work, very diligently, everything has to be checked, all the instrument panels, all the way in which everything is working. Plane has got taken off, all the signals clearances are done, announcements are done, you come to your cruising altitude 30,000 feet above, and then at one stage you put your plane into autopilot mode. Everybody following? Whether you are driving your car with a cruise control or not, chalo, okay, that was a little bit difficult question because many of the friends will say, "Sir, which world you are living in? I don't drive a car only. Today's world is there to just, invest in and travel in, taxis or like, radio taxi or like whatever. It's old fashioned. We are not like you, sir. I don't drive a car." Okay, but aeroplane to koi khud ka to nobody's. Very few might be having pilot license, but we sit in aeroplane, and how the pilot is using autopilot mode, that is important to try and align with our daily investing style, our lifestyle as well. That try to be active in your life, passive in your portfolio, and let's see what this kind of learning brings to us. With that, again, I'm taking a one quick pause, just 10-second pause to see any questions coming through, any inputs, responses, and then I will move forward, or let's jump into a few questions also which we have received till now. And then again, we'll come back to 1 or 2 slides which are there with some data points, etc. Interesting stuff, basically, right? Everybody with me? Okay. So let's quickly take a few questions, So there are some questions coming up. Thanks for raising. There is one question from Tridip Bhandari, that how to choose the right fund for portfolios for clients and how to invest in SWP for a client. Well, Tridip, I think interesting question. Not exactly sure whether you mean the portfolios of passive or active or a combination, but I think what we just covered some time back, the best approach in my view, Tridip ji, if you are a, let's say, a financial advisor or a MFD or a stockbroker, that based on the individual client's requirement or their specific life goals which you are trying to respond to, you need to try and understand which financial goals you need to align to, and then you can simply invest in 2 or 3 funds. Use a good combination, use some core and satellite type of approach that we just spoke about in a little bit detail, and then give that as a combination to your client with, of course, the clarity that you as the advisor or the trusted financial partner of the client can have this particular context in mind of a ongoing review, and at that point of time then you can have something which keeps aligning based on the market direction. I hope that answers very broad question, so a little bit broader response from my side, but like we all know, each client will have a slightly different and a subtle different slightly different risk and return objective, so we need to create our portfolio carefully based on that particular risk and return outcomes. Couple of other questions quickly moving. Bhavya Bhuktani, sir, can a second year student get an internship at a company like Goldman Sachs after clearing CFA level 1? Bhavya, great question. Difficult to give a very broad response, but yeah, definitely. The CFA program, in my opinion, is a very strong and robust learning. Of course, very often people get a little bit carried away that, oh, just because I finished L1 or now L2 or even L3 for that matter, I must get a job. Well, yes, it does enhance your knowledge to a great extent. But friends, we need to also be mindful of the fact that the CFA charter will be received only once you finish certain relevant work experience also. What I mean by that is that the CFA program is designed as a combination of reading and working. So please make sure you do both together such that you can have a better chance of getting your internships. Wonderful question from Piyush Verma. It's a little long, but I linked it to some ETFs and index funds, so I'm going to quickly read it. Hi, I'm a student trying to invest regularly. Wonderful. So that's what caught my eyes, friends. As a student, as a young professional, of course, sometimes what we just hear in stories and in social media posts that, oh, I started investing when I was in school, when I was not even 18 years and all. Okay, fine. That's very outlier or exception. Oh, I started investing at the age of 10 years and I felt I was too late. That's a filmy dialogue. Yes, it's good. It's powerful to start early and compounding. But if you're a student, if you're a newly started earning some small salary, boom, that's the best time. You must focus on some or either saving and planning and investing. So Piyush, that's what caught my attention. Quickly, I'm reading your question. I'm planning to invest 500 to 2500, which I can save every month. Wonderful. And I have the core and satellite system, which you mentioned. Great. And I'm glad people are listening to the session. I'm currently doing 75% Nifty. Well, I'm not going to use one company because Nifty Bees belongs to one particular company. So it could be Nifty Bees, it could be Nifty Ad, it could be anything. So I'm saying a Nifty index or ETF and 12% into a gold ETF and 12% into a junior ETF, means a Nifty Next 50 ETF. Okay, so nice. So you have approximately 85 to 87% equity, 12 to 15% gold as a commodity. That's good, good mix. And I try to keep this allocation the way it is. I do not plan to change anything for the next 8 to 10 years. Yeah, shall I continue with this? Piyush, I think that's quite a good outcome. Very nicely you have combined equity and commodity, that's great. And yeah, if you are in a position to carve out this kind of amount for the next 8 to 10 years, that could be very powerful. One small addition to that, if I may just suggest, Piyush, that see structurally, like how we would say okay, it's a wonderful and powerful thing. Slight, if you can make one addition over there, what we call as a SIP top up basically. So if you are currently being able to save around 2,500 rupees every month, is good. If at the end of every 6-8 months or at the end of every 12 months, maybe as you align a little bit more salaries incrementing, etc., try to keep little bit increasing that monthly allocation. That can be even more powerful. But otherwise, the mix of these two passive funds, one Nifty 50, one Nifty Next 50, and one gold, I think it's a good mix. As you enhance a little bit further, maybe, I'm just saying, maybe you could consider reducing little bit from, let's say, for example, one of the large cap plain vanilla beta product like a Nifty, and take some small element, let's say, for example, 10 to 15% away from that large cap to a small cap or a mid cap strategy as well. Sometimes, because you mentioned that your time horizon is very long, so that life goal for which you are investing is way off, at least 10 years away, like you mentioned. So maybe it could well be that some mid and small cap portfolio could give you a slightly better outcome, while of course having a slightly more risk as well. Okay, wonderful. Many questions are coming around certificates or acknowledging whether we'll get certificate for this course. And my friends from the NISM team are going to give you the full clarity around it. Rasmeet madam is, few other colleagues, I'm forgetting who all were there on the call, but most certainly you will get the clarity about certification, etc. on this particular course. Because friends, mind you, the idea of today's session is more interactive knowledge sharing, knowledge enhancement from my side. So I'm just going to keep my focus around that. Wonderful. Any other questions coming up? Something has come up in my question window. Okay. What would happen? Another question from Vansh Kamdar. Sorry, just a second. What if a person is having less income and wants to invest passively? For this, how he can manage? He has taken benefit of market volatility of investing in passive. Maybe I'll just rephrase this question once, and maybe you can clarify if I'm going right. I think what you're trying to say is that if a person has relatively smaller amounts, but I still want to participate in the market, then what should I do? Because currently we have got maybe less amount of income to spare. I feel doesn't matter. It's important to get started even with a small amount. So just earlier we spoke about one other question, which was about talking for a starting of an investment from 500 rupees to 2,500 rupees. So I feel the most powerful investment can start in a small way. Yes, you are right. Markets are volatile. At some point of time, in volatile markets, if you start investing, at some point of time, maybe using a passive fund in a volatile time helps one element of risk of the human bias getting taken away. So why not? You can consider starting with a small monthly SIP as low as 500 rupees, maybe 1,000 rupees, whatever is available, as a clear-cut saving out of whatever income and expenses are there, and keep investing in a low-cost, passively managed index fund or ETF. Because any which ways, we have small amount, having the cost as low as possible is a benefit. So yeah, you can definitely consider that. Okay, Piyush Dubey, ETF is best. Invest for 10 years. Wonderful. Thanks. That's a great approach and a great suggestion. Thank you. Vaibhav Khanna, how to understand which fund house takes investment decisions aligned with ours or our clients. Not exactly sure what you mean, but I'm presuming you are trying to say that are the fund house's principles aligned with keeping investor first or making sure that the interest of the investor is kept ahead of the interest of the personal gains of that particular company in terms of profitability? Well, I think that's a gradual thing based on the fundamental and ethos of the particular company or the group who is running that mutual fund. You can gradually try to get some sense about whether they are focused around investor friendly approach, etc. Which, if you recall, friends, that that chart with 6 parameters which I had shown, you can consider to take that. I'll just quickly share it once again for the benefit of everybody. And as a recap of that, this was the chart that I was referring to, which you can consider while identifying or looking at which particular fund house to select for your ETF or index fund. So I think good question, and thanks for that. Okay, couple of more questions, friends. Quickly keep typing. I am not seeing many questions. Oh yeah, a lot of questions coming up. Little bit down in the screen. But now, since my presentation is open, let me quickly jump into close the session as well with the last one slide from my side, and then again we'll come into the Q&A in 1 minute later on. So we spoke about here how to remain aligned with your thinking, how to try and make sure you identify your life goals, then align your financial goals with that. And yeah, actually, this was the from perspective of the slide, just the last thing from my side. So yeah, we will come back to the questions. And this was very important from my side. Very often in such online sessions, we tend to miss each other or miss some questions. So don't worry, I am available very actively on LinkedIn. Reach out to me later on as well. On the first Sunday of every month, I am live on this session called Aage Ki Baat. So feel free to raise your questions, but let's jump into some of the questions which are available on screen right now. So Vaibhav Khanna's question we completed. Thanks for that. How do we look at the fund and how they are looking at the investors' interest first? Himanshu Verma has a nice question. What is the minimum amount for the best portfolio construction? My dream is to make 5 crore equity portfolio in the equity capital markets. Well, I think Himanshuji, it's difficult to put a number, but yeah, I think 5 crore is a good target to have in mind. Depends on the time period that you're looking at. But I guess if your time horizon would be in the range of like maybe 5 to 10 years, then yeah, it would be good to start with a combination of some active and some passive funds, and ensure that you regularly keep allocating amounts which will help your compounding journey to reach to your 5 crore target. So a little bit less of inputs about the exact number of like how you have thought of to start and how much time you have. But most certainly, it's a good thing. Very clearly identified life goal. I want 5 crore maybe to buy my new house, or maybe to do a expansion of my business, or buy a new clinic, or whatever it might be. And this is the timeline. Then aligning that with your investment. Okay. How many number of mutual funds is sufficient for a individual person's portfolio? Shubhranshu Mondal has asked. Wonderful. Well, Shubhranshu, difficult question, little bit simple answer. Structurally, I would say for a simple individual, keeping the life very easy, it could well be only one fund. I'm just saying, you could select one hybrid fund, which has allocation of some equity, some fixed income, some commodity, little bit global securities if possible, low cost product, and that's all. For example, that could be very sufficient. Otherwise, depending on if the person has 2 or 3, 4 key life goals, and if you can align one by one 3 or 4 financial goals to each of them, then subjectively take a call that if one of the life goal is very far off, invest in a very aggressive, let's say mid cap, small cap portfolio. If some goal is little bit relatively near term, let's say about 3-6 months away, maybe you can invest in some debt funds, in some arbitrage funds, in some liquid funds. So based on what we just spoke, powerful thing would be define different life goals and then have the requisite number of funds taken. Don't worry, it could be only one fund also. It can be a powerful enough portfolio, or it could be 5, 7, 10 funds also. It doesn't matter, as long as you have the comfort and clarity that either you yourself or your trusted financial advisor or MFD or stockbroker is going to be able to manage and review it and give you a periodic insight and guidance on that. Okay, lots of questions now coming in and little less time, but let's take one last question before we move on. Let's see, some of them are just questions around the certification and all, so I'm going to respectfully ignore them for now. What habit has contributed the most to your success in investing? Yash Gosen. Well, I mean, interesting question, Yash. To be very honest, my investing for personal side has been very boring. Very straightforward, very boring. A large component of my monthly amount goes and sits into NPS, which is for long-term parked away, locked-in money. Small component goes into my two of my index funds. My two of my SIPs, very long-term, are going into actively managed funds of my under my DSP's team. So if I would say one habit, I mean, I would say keeping it very boring, that has contributed or that has helped over these past so many years. If sometimes you keep doing some or the other activity, some or the other churn, very often you might land up, in fact, losing on from what you were actually aligned towards your goal. So yeah, that's one particular thing I would like to share. Yash, good question. Thank you. Okay, yes, and NISM team has given the clarity and response that all attendees will receive the certificate via email. Thanks a lot, NISM team. So friends, rest assured, whoever is part of the session, and I believe there would be some requirement that you have to log in and wait till the end and all, whatever be the criteria. But rest assured, you will get some certificate as appropriate. So now we are just coming to the end of the discussion. So I will request sincerely that lots of questions are there. I greatly appreciate. And a lot of you very eagerly participate in the earlier thing also by typing the A and N's and the P's and engagement. So it was a good fun. I urge you, I request you, please keep the quest for knowledge enhancement alive. NISM is a wonderful platform, not just today's session, but you will get various such sessions, online, offline, in-person engagements. I've personally been associated with NISM way back in, I think, 2006-07, when early days of NISM, and done so much together. So I can vouch for it. The quality of thought process behind each and every study material or module, whether online or offline, is very powerful. Keep up the quest for knowledge enhancement. I hope today's session is useful. Keep posting some questions. I do apologize, but lots of questions, not able to take every question right now. I hope you can align later on. I'm again sharing my screen. This was the last slide in my screen that in whatever small way I can be of help, I'm always available and happy to help. Do reach out to me. I'm available like this same way on a live platform once a month on the first Sunday of every month. Feel free to drop a line and ask any questions. So with that, taking a quick 1-minute pause to check with Rasmeet and Sahil and other colleagues from NISM. How are we going? Should I take a pause and wrap up and conclude? Should we continue? What's your usual trend? But we are taking a quick 30-second pause.
Hello, sir.
Yes, dear.
I think, sir, we can take couple of more questions and then we can conclude the webinar.
Okay.
Okay.
Wonderful. Great. So let's take few more questions. Uh, moving from the backward and of course some from the forward, I'll keep jumbling up so that some of the questions whichever are good, I can take up. Sorry, it's being a little difficult for me because I have to keep scrolling up and then some question goes down, so I have to again come back. Vicky Patra has got a good question that during your early years doing research work, what was the toughest challenge you faced? Vicky, I would like to highlight slightly differently. Instead of focusing on equity, I would like to discuss my journey during credit analysis. So all the friends who are from investing background, I believe most of you might have read or got this book, The Intelligent Investor, right? Everybody who has read it, just type A, yes, I've read the book, or no, I don't know who the hell you are talking about, Intelligent Investor. It's a red colored book. Everybody must have it. If not, I also stored one over here in my small library behind. The Intelligent Investor, written by Benjamin Graham. Right? It's a master class of value investing, equity investing, etc. In that book of equity investing, Mr. Ben Graham, who supposedly is the guru of Warren Buffett. Warren Buffett acknowledges he has learned a lot from this book and from Mr. Ben Graham. He uses the word credit, balance sheet strength, credit defaults in about 300, 400 places in that big thick book. So, to be a good equity analyst, you first need to be a good credit analyst. That is what I have learned in my journey. And for being a good credit analyst, we need to be very clear that we have to focus on how we are going to track the cash flows of the company. Often as an equity analyst, we focus on the P&L, how the earnings profile is going to increase or improve. Whereas in terms of the credit analyst, we often focus on the balance sheet strength, that how our balance sheet and cash flow is going to improve or increase. So what I would request that as a learning, if one would ask me, I feel that having a strong grip on the fundamentals of a company balance sheet as compared to just the fundamentals of the company's P&L is very, very important, and it will hold you in very good state as you grow as an analyst. So that was one learning which I have found very useful in the past, basically, Okay, Ajay Kumar has asked that can we invest passively in foreign markets and suggest some source how to start it. Ajay ji, I think maybe you joined a little bit late or maybe you missed it, but I did discuss about international investing. I'll just quickly recap, So sometimes, these there are certain constraints in terms of investing in foreign markets because right now there are limits of the RBI and SEBI which have got packed. So as of today, we don't have any passive fund in India which is open, very few maybe one or two, but otherwise to get access to such a fund which can invest passively in a global markets, RBI and linked to that SEBI has certain limits, upper cap of $7 billion for active funds or stocks, $1 billion for ETFs, and both these limits are right now packed. So there is a route, yes, you can invest through LRS and take the money out of Indian jurisdiction, either in a GIFT City vehicle or directly outside into global vehicle and invest in a foreign market. So that could be the best source. And how to start it is maybe to keep it simple, go to a GIFT vehicle so you feel a little bit more comfortable. You'll have to park the money from India to the global account in dollar denominated through LRS. And then you will have to think of which particular index. Let's say you want to invest globally in a passive fund, let's say in a NASDAQ or in an S&P 500, or like we spoke about earlier that, okay, if I don't want to invest in S&P 500, I want to invest in S&P 500 equal weight strategy. So you can think of some particular ETF or index fund investing in S&P 500 equal weight strategy and meet your requirement. I hope that helps basically, Ajay ji. Okay, so that's one more question we can mark as answered live. any other important question which I can quickly respond to? Vicky Patra asked a good question. Okay. Thank you for the wonderful session. Thank you. It's anonymous attendee, but I greatly appreciate your feedback. Thank you, boss. Nitin Gandhi, sir, how much time does it generally take if I plan for the CFA? I have completed my CFP. Well, I mean, maybe this is not the right forum. NISM friends will scold me because you are digressing from the topic. But yeah, it's great that you have completed CFP and pursuing a CFA. Link me up offline on LinkedIn and I'll reply to this maybe in the next series of LinkedIn Live. Sir, I want to get an internship. Sir, please help internships, jobs. For all of those, please, I request you come on board to the LinkedIn Live session. We will try our best to respond to that. Shubham Saware has got something interesting. Seems like how should a MFD, means a mutual fund distributor, assess whether a fund house has a reputable investment process rather than relying mainly on recent performance? Shubham, this is a great question. I think this is more for actively managed funds as well. I feel very strongly about this, that rather than focusing on a very recent performance or outperformance or even underperformance, it's important to track that particular fund house over a long period. It's important to track rolling returns over multiple cycles and then try and take a judgment of whether the process or whether the investing framework which that fund house is applying has been done consistently, and whether they have a way in which they can enhance the returns profile for the investor. What I mean by that is, if they are following an investment framework which has a proven track record, and if that framework is resulting into an outcome which currently is underperforming, maybe once the current market scenario or market environment changes, that performance will also change and come back. So very important to try and keep that in mind. I hope that helps. Anonymous attendee, how to contact you, sir? I'm here live in front of you. Ask whatever you want. And I've shared my screen. This is my LinkedIn handle, Anil Gilani. Very easy, very simple. Ask me anything. The session is there once every month on the first Sunday of each month. So always happy to try and respond to any and every questions. Today was Guru Purnima special, so I came on board for sharing. But even other than that, on the first Sunday of every month, any questions about asset allocation, investing, over there, I'm open to even discuss about careers. Bhavya is asking again about internships, jobs, CFA, CFP, everything. Feel free to come on that platform and we'll discuss in more detail. For today, let's keep it focused around what the session is for NISM, passive investing for today's world, the way in which we are supposed to look at the simple form, the discipline in which we are supposed to work with for creating our wealth. So with that, let me conclude from my side. Thank you very much, friends, for participating and being such a wonderful audience. I also got to learn a lot while trying to respond to your questions. And thanks a lot to that NISM team. It's great to be on your platform for any and every occasion. I've come to your platform so many times in person as well as online. But today was super special for me also because it was a Guru Purnima special. So thank you very much, friends, and all the best. Stay safe. Good luck.
Thank you very much, sir, for sharing your valuable insight with us today. I'm sure everyone found the session informative and useful. So before we conclude, we invite attendees to participate in the NISM deal making contest. To learn more, I will play just a short video. Also, I will be sharing the link in the chat for your convenience. So please hold on. I am sharing my screen so that you can get more information regarding to it. Yes. Wait. What's the Right. So could you stop your screen so that I can share mine? Yes, thank you so much. Shrikant sir, please give me the share sound option. I'm just sharing the link in the chat so you all can visit the website. Yes, so I have shared the link in chat so you all can visit NISM website for more information. Yes. Also, I'm launching feedback poll questions, so do participate in it. So yes, on that note, I think we can conclude the session. Thank you so much, Anil sir, for the time and value which you shared, and also thank you to all the attendees as well for joining us today. So thank you so much. Thank you, everyone. Now I request IT team to close the session.
Hello.
Yes, you can conclude the webinar.
Yeah, Sahil. Sahil, we can end the webinar.
Yes, yes.
Okay.